The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, Friday the 28th of March. Jeremy, welcome back. Good to see you again.
Hi, Gareth. Yeah, nearly the end of Q1 2025.
It is indeed. And it's been another interesting week. Lots to talk about in terms of the UK on the back of Rachel Reeves' statement, and Donald Trump's been entertaining us from across the pond a little bit more. But let's start with the UK. What did you make of Rachel Reeves and her statement earlier in the week, and where do you think we've got to?
Well, I'd say one piece of good news this week was that UK inflation for February came in at 2.8%. And I think for the UK, that's probably where the good news ends this week.
Okay.
Just to put that one into perspective.
Quite quick. Yeah.
The UK has recorded just 1 month over the last 46 that was below the official 2% target. So basically, the last 4 years, the UK Consumer Price Index is up over 25%. The bottom line is that we're not looking like returning to target anytime soon. And this still has implications for the battle to lower rates, which following the spring statement is a concern, not just for mortgage holders and other indebted people like companies and so on, but for the government itself. As you say, the sort of highlight for the UK this week was Wednesday's statement, which the Treasury was at pains to present and describe as not a fiscal event. But the event, as one might have expected, was really an exercise in putting lipstick on a pig and kicking the tough decisions down the road until the autumn. And it's basically an exercise in trying to kid everyone that they are in control, that their models and their rules of fiscal discipline are effective levers over managing an economy and its ability to manage a tax take from that economy in a manner that we are all supposed to take reassurance from. But it's not just about us, the taxpayer or the investor. It's more importantly the bond market, and particularly the bond market with its vigilante tendencies. This is what's boxing them in and making them do what they do.
Okay, so there was no chainsaw-wielding, cost-cutting Doge replication, but did she do enough to satisfy those bond market vigilantes?
Well, yeah, I guess. The measure is what happens to bond yields, to gilt yields, and the 10-year gilt yield didn't spike. There was no dramatic response. Critically, the pound is relatively strong. So, yeah, we're not in an actual financial crisis, but the state of the government's balance sheet, the state of government spending and the state of government deficit has not been addressed. I was particularly triggered when I saw a headline in The Guardian yesterday that said Rachel Reeves accused of balancing books on back of the UK's poorest. Forget the second half of that statement for now, but the notion that she is doing anything that could remotely equate to balancing books through this non-fiscal event is just fanciful. The £9.9 billion buffer that was there, wasn't there, and now is there again sounds great. But in the context of total government spending of $1.2 trillion, it is literally meaningless. It could be wiped out with one spike in interest rates, one executive order from the Oval Office, and it's dead and buried. And when you bear in mind that these are figures that are typically forecast over a 4 or 5 year term as forecast by the OBR, so they actually equate to the future value of government borrowing that is based on forecasts that have never been accurate in the first place, ever. It just makes you realise that it's just performative. But in the short term, while Rachel Reeves is having difficulty with her backbenchers and even with some of her cabinet colleagues about some of the things she's trying to do to manage this impossible position that she's in the short term, her biggest problem is none of those, but it's the bond market. The reality is that even if the Bank of England were mindful to cut policy rates, in order to try and address this issue. Such is the reality of our inflation problem that almost immediately, if they were to cut rates today, they would lose control of the long end of the gilt market and would have to initiate some form of yield curve control or some form of capital control, the likes of which we haven't seen since the 1970s.
Okay, so not uniformly positive.
Afraid not, no.
No, that's okay. The press is saying that there's a risk there'll be tax rises in the autumn in the budget when there is a proper fiscal event. So that's the worry.
Yes, I think it's almost nailed on. The nature of the problem has changed from the inherited black hole from her predecessors to the external threat, which is in the far off land of Trump, and creating all this global uncertainty that is putting her well-set, well-meant plans into jeopardy. But in the meantime, we've got quite a lot to keep us busy in terms of what's coming out from the Oval Office.
Indeed. So what has the Orange Peril been up to this last week?
Well, it's all about tariffs, isn't it? And it's all about tariff uncertainty. Everything is now being focused from the US on what they're calling Tariff Liberation Day, which is next Wednesday, April the 2nd. And the latest nail in this particular piece of economic warfare came on Wednesday in the form of the auto tariff executive order, which is a 25% tariff on all automobile sales made outside the USA. And that's something that even the UK government seems to be finding difficult to sidestep.
So the trade wars are mounting in their scale and coming a bit closer in terms of the date when some of them really take effect next week. So that's all quite scary. How are markets reacting to that?
Well, I think what we'll probably get to hear more about in coming weeks and months is not just trade wars, but capital wars. And I think this directly impacts bond markets and equity markets and capital markets generally. I mean, capital, we know, travels to where it is treated best. And we've all become habituated in the idea that the US has been the preeminent place for capital. And it also happens to have the world's reserve asset in the form of the dollar. But the longer all this other stuff goes on in the world and the uncertainties created by the fact that the world order has changed and now it's having to be accepted, things at the margin are changing. Increasingly, global investors are diverting funds away from US assets towards other regions of the world. Now, it's estimated that somewhere between 10 and $15 trillion of European assets are invested in US markets, much of which is unhedged. That represents approximately 20% of the value of the S&P 500. So let's say 15 to 20% of the S&P 500 is owned by European pension funds and other long-term capital. Now, if you believe that there is an erosion in the attractiveness of US markets, we're all overexposed collectively, basically to the Mag 7 and the US dollar, which even the US government, sort of on its not so clever days, accepts its own dollar is currently overvalued. So there's evidence that following the DeepSeek revelation on AI, the Chinese stock market spikes by 20% in the following couple of days. We get €1 trillion fiscal stimulus in Germany because they wake up to the fact they've now got to defend themselves, and its stock markets go crazy. So we're seeing the sort of fast twitch response of capital leaking in a very small way to some of these off-the-run capital markets that most global investors have happily ignored for over a decade, and they go up massively. Meanwhile, US policymakers are saying they've got to go through what they're calling a detox period, a period of slower growth. And it is impacting the way people are starting to allocate capital. And that whatever type of investor you are, you need to be more broadly geographically diversified than you probably are. And it's unlikely that the UK can remain immune from all this. And given our starting position, I would say the UK is more likely to be a recipient of these changes than a detractor from it, given the way things have been over the last decade.
Yeah, makes sense. And if that is the result of Trump's antics and his aggression or his assertion of the way that he believes the world order now is, if that scares capital and worries people about leaving it invested in the States and it flows in our direction, then yeah, there could be a huge amount to go for in terms of investor activity and opportunities in the UK market. And that's a great way to talk about the UK market, because this week we've actually seen a number of stocks who've delivered results roughly in line with expectations, nothing amazing, but we've had some really quite significant share price moves on the back of relatively expected news delivery. So company news that we've seen in terms of progressive clients would be Xaar and Gamma. So Xaar, which is a manufacturer of print heads into the industrial printing market, they delivered a 2024 result pretty much in line. They were talking in a relatively upbeat way about the remainder of 2025 and moving forward. The shares are now up 35% across the week. So that was obviously very, very well received results from them. We also had Gamma, which delivered FY24 results pretty much in line. Their news was less well received, though. The shares are roughly flat across the week. That's a combination of the UK business performing pretty well, but Gamma overall doubling down on its operations in Germany. They made some significant acquisitions in the German market in the last 6 or 9 months. And I think some people are slightly worried that they've paid a high price for those deals. What I'd point out, though, is actually that the German market is starting to show signs of life. As we've just been discussing, there's a huge fiscal stimulus coming into the German economy, which can only help to make companies more prepared to invest. There'll be money flowing into those markets, and some of that money will help companies move their telephony or their telecoms into a more modern, more cloud-based telephony platform type way, which is exactly what Gamma offers. And Gamma themselves have been highlighting that the German market for them now looks very much like the UK market did about 10 years ago in terms of numbers of customers, overall size, and level of penetration in terms of cloud telephony. So there's a lot to go for. I think Gamma are very confident that they can deliver on that German opportunity. The market at the moment is still slightly jury out, but we have to wait and see. And then the other piece of news was SRT Marine, which is a provider of maritime monitoring systems. They had, again, a pretty good 2024 result. Most importantly, they're starting to see the effects of some significant contract wins that they've been talking about for some time. They're really starting to show through. The SRT Marine share price is now up 25% across the course of this week. So to your point, Jeremy, if capital is flowing into the UK, it can make a massive difference in a pretty short space of time. And it feels, in terms of the way companies have been priced and the way share prices are currently pricing in, there's a lot of caution, a lot of pessimism already priced into these shares. So even in line or moderately positive delivery is extremely well received. So hopefully there's more of that to go for across the rest of the year. So yeah, as ever, a huge amount going on, lots to look forward to. What are we looking forward to just in the week ahead, though? What's coming up in the next 7 days?
Monday and Tuesday, we get two main confidence measures from China around Chinese manufacturing. We've had evidence that things have, for now at least, stopped getting worse in China, but China probably needs news that things are improving for its market to kick on. It's done very well year to date. So we'll have to see on Monday and Tuesday whether these PMI measures of Chinese manufacturing can give us that confidence. And we get inflation data out of the ECB on Tuesday, which is expected to show a drop in inflation year on year for last month, falling from 2.3% to 2.1%. And on Wednesday, we get US jobs data, followed as always on Friday with the infamous non-farm payrolls. And this month on the non-farm payrolls, we're expecting to see a drop below 100,000 new jobs versus the normal trend we've seen over the last 2 or 3 years of around 200,000 jobs. But this is a very volatile number. But I think the market is expecting a figure sort of decisively below 100K, which will be the first time we've seen that kind of figure in about 18 months. But I think on the trade headlines, it's going to be about what Trump's calling Liberation Day for tariffs, which is on Wednesday, on April the 2nd. So let's see.
We'll see whether he cancels it or not.
Yeah.
There's all sorts of opportunities for April the 1st jokes, Trump cancelling the tariffs. But yeah, let's see what happens. Great. Good to speak. And we'll chat again this time next week. Talk to you then.
See you then.
Brought to you by Progressive Equity.